This is what really makes you stand out and see the big picture of where I think we are for gold. Each time we hit 100% measured move and gold rallied, gold pushed through those levels and shot higher with very little resistance. Each one of these, including the one we see right now, was 22 to 24%. And then we went into a multi-year pause or correction. And I believe we're entering into a economic kind of recession. I think we're going to have something like 2008 where gold pulled back 34%. I think we're going to see gold pull back substantially again going forward. And from a big long-term point of view, I'd be very, very nervous to buy gold up here because I think you'll be able to buy it at a fairly good discount.
Gold prices regained some ground during the North American session on Thursday after economic data from the United States indicated continued deceleration in factory gate inflation. The producer price index for April unexpectedly declined by 0.5% month over month, falling short of the anticipated 0.2% increase. Similarly, the core PPI dropped by 0.4%, missing forecasts of a 0.3% rise. These figures suggest weakening inflationary pressures, while consumer spending appears to be dampened, in part due to the impact of U.S. tariffs. In response to the data, gold rebounded from a 5-week low of $3,120, climbing back above the $3,200 level. However, despite this recovery, the broader technical outlook remains cautious. ChrisVermeulen, chief market strategist at the Technical Traders, notes that from a long-term perspective, particularly when analyzing the monthly chart with Fibonacci extensions, gold has likely reached or is approaching significant long-term targets. Technically, the bounce in gold may be short-lived if buyers fail to secure a daily close above $3,200. A move above the May 14th peak of $3,257 would be necessary to sustain momentum and aim for a retest of the $3,300 level. Without this, the risk remains tilted to the downside. The relative strength index also signals weakening momentum, indicating that the current recovery may be a corrective move within a broader downtrend. Meanwhile, gold-related equities and exchange-traded funds, ETFs, continued to lose ground, reflecting reduced interest in gold as a safe haven asset. Several mining stocks have begun flashing sell signals, reinforcing the cautious sentiment in the sector. According to Vermeulen, while gold miners had previously staged a strong rally, they are now encountering primary resistance levels and displaying signs of fatigue. With the potential for a broader market sell-off on the horizon, both gold and miners could face deeper corrections in the near term. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I feel like it could be the end. So, I mean, we recently had a little trade in gold. We got long down here on a signal. We exited up here, sold some profits off, and we're out of the trade. And it looks like it's trying to put in what looks to be a double top formation. With that being said, it is still in a bullish environment. You do not want to bet against it. You can play moves to the upside, but I'd be leery on trying to bet on falling prices for gold. And I think the best visual, if you step back and look at the big picture of gold, the monthly chart, David, has got really interesting price action, which is, if we were to zoom back and use Fibonacci extension, you and I have covered this before. There's multiple levels from the big rally that we had in 2011 all the way to the pullback. It coincides with this 100% measured move way up here, 2,800. Well, the start of the new super cycle back in 2015 and the rally up and the pullback here in 2022 also coincides with the same level. So there's two massive time frames playing out, and we're in this unique situation right now where each time we've hit these 100% measured moves, these Fibonacci measured moves on the charts, we've hit some here, we hit another one back over here, we hit another little one back over here. And this is what really makes you stand out and see the big picture of where I think we are for gold. Each time we hit 100% measured move and gold rallied, gold pushed through those levels and shot higher with very little resistance. Each one of these, including the one we see right now, was 22 to 24%. And then we went into a multi-year pause or correction. And I believe we're entering into a economic kind of recession. I think we're going to have something like 2008 where gold pulled back 34%. I think we're going to see gold pull back substantially again going forward. And, from a big long-term point of view, I'd be very nervous to buy gold up here because I think you'll be able to buy it at a fairly good discount. And what else is interesting is we have these long tweezer candles, meaning price ran up and then it got slammed. It got sold back down, and it ran up this month and it's getting slammed back down. That's generally a reversal type of candle. We had something like this back in 2011. It doesn't always mean it's going to get, rejected and be a trend reversal. You can see here, we had two tweezers and it ended up holding its ground and breaking through it. But now we're at that 24% surge after our 100% measured move. And to me, it feels like we're going to see a significant pullback. It seems like the easy money was made in gold. It's hit its target, it blew right past it. And now it's showing volatility. For gold to be moving 2.5 to 3.5% like every day, that is huge volatility for gold. It's a pretty small market, and volatility usually means a turning point is coming. And so I think that's what people need to be aware of. Is I think a reset is coming back in gold, and we're going to see it have a deeper correction. Gold miners have had a really nice run. They've had, a rally up, a pullback, another measured move rally. They have recently hit major resistance, a very significant pivot resistance. It became support a whole bunch of times through here, then resistance. So there is no doubt, it's hit its move. It has more, I think, as well topped with gold hitting resistance. So gold miners, I feel like they're getting rejected. They felt like a little bit of a lot of people were piling into the miners because obviously they were moving up. But just like how I follow in trade sectors and stocks, you have to look at the indice itself, find out if the stock market, what that trend is doing, and then you use that analysis. So for the gold miners, I would look at gold and say, okay, well, gold has just put in what looks to be a major top. Gold miners look like they have also put in a major top and they slammed into resistance. And just because they had a big percentage run doesn't mean it's the start of something much bigger. I feel like we're actually going to see a bigger correction in gold and miners. If the market does roll over and sell off here over the next month or two, miners are going to get beat up. Gold is going to get beat up. And a really good comparison chart actually is I have charts of the S&P 500 weekly charts. The one on the left here, the candlestick background, that is the 2007 market high and the start of a correction. Well, we saw the S&P 500 fall about 20%. And if we look at today's price action and where we are, we saw this initial bout of about 20%. And, when you look at what gold has done, which is this yellow line, as the stock market starts to top, gold starts to take off. And it continues to blow by and outperform. Well, we've done the exact same thing. The stock market recently pulled back. The stock market was putting in a top and gold has shot higher. And, after that, the stock market eventually falls off a cliff and it fell 57% and gold pulled back 34%. It eventually found a base and then shot higher, which is going to be the next golden opportunity, pardon the pun. But overall, we are in this unique situation where we have a very similar setup to 2008. And the biggest thing for, I think, people to see is I look at price action in the markets. This time around is very different than 2008. The tech bubble was very different than 2008, but stock prices do the same thing. When people are bullish or they have FOMO if they're missing out, price goes up. When people get scared, they don't know what's going on, price goes down. It doesn't matter what the underlying reason is or the setup. It's just people are either buying stocks hand over fist or gold or dumping it. And so I think we're in this unique situation where eventually the market is going to roll over and have a big sell-off and sell off and pull gold and silver down with it. And gold and silver, they kind of move together. If I was to overlay the silver chart, you can see the white line here. It moves pretty much with gold. If gold is trending up and to the right, silver is generally trending up and to the right. You can see the same here where we are right now, that gold has been trending up and to the right, so has silver. They're the same trade. Gold, silver, and miners. The only difference is they have different levels of volatility. And, some of them, silver's noisy and choppy. Miners are noisy and choppy. Gold is a much more steady play. But that's kind of where I see us in the grand scheme of things of the stock market.
The S&P 500 advanced for the fourth consecutive session, while bond yields declined after 5 straight days of gains, as investors grew more confident that trade tensions would ease and the U.S. economy would remain resilient. The broad market saw limited directional movement for much of the day, with major indexes drifting sideways before closing mixed. The S&P 500 ended the session up 0.4%. The Dow Jones Industrial Average rose 0.6%, adding approximately 272 points, while the Nasdaq Composite slipped 0.2%, weighed down by weakness in the technology sector. Investors appeared largely unfazed by Walmart's announcement that it would raise prices later this month and into early summer in response to the ongoing tariff situation. While such price hikes could have broader implications for the retail industry and consumer behavior, market participants seem to discount the immediate impact. In the bond market, yields on the benchmark 10-year U.S. Treasury note pulled back to 4.454%, down from 4.529% the previous day. The decline followed a 5-day rise in yields and reflected a modest return to risk-off sentiment, despite equity markets maintaining upward momentum. ChrisVermeulen argues that the recent market strength may represent a bear market bounce rather than the beginning of a new bull run. The S&P 500's breakout above the March pivot high has triggered fear of missing out and forced short sellers to cover their positions, creating a surge in buying pressure. However, Vermeulen warns that such moves have historically preceded significant market declines. While the current rally is strong, he sees it as potentially the final leg of the advance before another downturn takes hold. Let's get back to the interview.
The news really kickstarted the week. The tariff news sending stocks higher and making people want to run into the risk on assets. They're dumping. We're seeing gold fall. We're seeing utilities fall. We're seeing pretty much all the risk off assets selling off in a big way, and they're moving into the riskiest stocks. People, I think, are kicking into high gear, thinking we're starting a new bull market, which maybe we are, but at this point, we're still in what I think is a dead cat bounce. And when we take a look at the charts here, David, there's quite a bit going on. There's definitely a lot going on this chart. And the biggest thing I think you and I had talked about this a few weeks ago, is that I was hoping this market was going to break this pivot high that we saw back in March, and hopefully see it on big news. It would probably create some type of short squeeze of people who are bearish are going to want to cover. And it's going to get people really bullish. And that is exactly what you just said, is people now have gone from a bearish tone to a very bullish tone. And now suddenly the script has changed. Everybody who's thinking the markets were going down, or now all we're hearing is V-shaped bottom, new bull market has started. People are moving into the riskiest sectors. And I have a hot list that I keep track of. And what's interesting, if we look at the hot list, this is yesterday, all of the top performers ranked going forward are all the risky stocks: the ARK ETF, solar, Bitcoin, semiconductors, oil and natural gas exploration. We've got all of these very lucrative sectors. And when people pile in to all of these at the same time, and they start to outperform and they work their way up this list, when this is a sign that the market is people are bullish. Typically it's a contrarian play. We saw the same more or less over here just before the stock market kind of went off a cliff. Everybody gets really bullish. Typically you need to break some previous pivot highs. So the market came up and it broke a little bit of a high here. We saw small caps and micro caps and aggressive stocks do well, and everybody piled in just before it sold off. And now that's kind of where we're at again. And just the momentum, just on this most recent rally using a Fibonacci extension, we had this rally up, we had this big pullback and intraday reversal. And if we carry that forward, it brings us right to where we are. This is where I think you and I actually talked about this. I was looking for 5,900 as the upside target for the S&P 500, and now we've hit that, and now it's trying to figure out if it can push a little bit deeper. So the trend has kicked up into an upward trend, but in the grand scheme of things, I still think this is a big bounce and rally within a bear market. Now, we just have to wait to see if it rolls over or if we make new all-time highs. But from this standpoint, this is still a bounce, and it's sucking investors and traders in just before it's probably going to roll over, and I think head a whole lot lower. Well, a dead cat bounce can be pretty darn big. I mean, if we go back and take a look at the long-term investing chart of the S&P 500, and we just go back to this is the weekly chart of the S&P 500. Now, we saw the market break down. This was in 2022. The market turned red, telling us, hey, we're in a bearish environment, but we have this very strong dead cat bounce, this bounce back up that comes up into resistance. And so a dead cat bounce is a bounce up. It's also known as a bear market rally. And we have this same scenario. We've got a bounce or a rally within an overall downtrend. Based on technical analysis, the momentum has stalled, it has rolled over, and it is pointing to lower pricing, just like we saw in 2022. So until we break to the upside and a bunch of other technicals confirm that, hey, this rally actually has strength, I'm looking at every bounce as a bear market rally at this point, or a dead cat bounce. It's just a lot of fear hits the market, and then it has this very sharp knee-jerk reaction bounce. And we just have to wait to see how it plays out to be like, okay, was it a dead cat bounce, or is it actually a V-shaped recovery and the market turns up? In 2008, it was a V-shaped recovery and it kicked up into high gear and we went into this bullish environment and there was a nice big move. So you always have to play the protective side. Always protect your capital. Play what statistics and odds are showing in the technicals until proven wrong, and then you have to adjust your position. And so if the market does turn bullish, we'll be riding the market higher. We are long the markets from a short-term standpoint, but a long-term investor, we're in a bullish environment and we're really just waiting for this market to roll over and sell off in a bigger way. I think the markets have slowly been getting back to what feels like the norm. Stocks up, bonds down, stocks up, gold down, and that's kind of what we've been seeing. I mean, gold and bonds have been moving lower every time we see the stock market move up, and it's pretty straightforward analysis. As people are coming out of defensive plays where they're like, oh, I think I'm safe here, and they're saying now I want to move over to stocks and equities to take advantage of the upward move, and it's nice to see that kind of regularity, but I think it's just money sloshing. The stock market and all the different assets really is just a giant ocean of money flowing out there, and money sloshes from one asset class to the next. And wherever people think there's safety when they're scared, they'll move there. Gold and bonds. If they see that they want to ride a wave and they think the market's really bullish, they're going to move their money into a different asset class, so that everything's connected in a way. And so when one asset's coming down, that money's flowing somewhere else. And so we've been seeing it out of bonds, out of gold, and into more or less riskier stocks to take advantage of potential upside moves.
Despite gold's recent price rebound, the broader narrative remains one of uncertainty and caution. Mixed inflation data and weakening momentum indicators have added complexity to the short-term outlook, with technical resistance and waning investor enthusiasm creating headwinds. While equity markets continue to show resilience, bolstered by hopes of easing trade frictions and firming economic indicators, underlying skepticism persists. Gold-related assets, once buoyed by safe haven flows, now face pressure as traders weigh the potential for further downside. Given this fragile setup across both precious metals and broader financial markets, could the next catalyst be a decisive shift in monetary policy or an unexpected geopolitical disruption? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.